Good evening to all of you. It's a real pleasure to introduce Swapnil, not as just our past student, but as an author today. I think, I just talking to him that how did he get interest in macro? Was it he got interest during his time as a student? He said, yes. One reason for him to come to IIMA was actually to learn macro. This is something very, very special. So, Swapnil, welcome to IIMA. Let me introduce you formally. And Swapnil is primarily a fintech entrepreneur, professional who is working over 18 years in the intersection of technology and financial services. He has been a keen researcher in macroeconomics. He's a graduate from IIT Bombay and then PGP from IIM Ahmedabad in 2004. Swapnil has a wide experience across, I think, blockchain, quantitative strategies, multi-asset portfolio management, credit and alternate assets. As a founder of ASQI, he currently spearheads the core team of New RL, a public blockchain aimed at mainstream financial services. Swapnil, at some point in time, if you can even tell how you are working on financial services, through blockchain could be useful for us, besides your book. Okay. And earlier he was the quant hedge fund manager at Engineers Gate and also worked with the BCG, advising clients across engineering, technology, and banking sectors. He has been recognized as one of 40 under 40 professionals in alternate investment space in India. He is married to Chobi. It's very hard to, talk in front of your wife. I see that, Swapnil has a challenge. So, and his batchmate and who is currently CEO of IIMA Endowment Fund. I think there is a close link of the book, where Swapnil is really trying hard to explain that money is not the way we think money. Money we do not consider as a resource, where we find his wife is effectively trying to do creating resource for IIM. So, yes, so that's, I think, to begin with, that's a very nice combination for the book talk. So his interest lies in macro, blockchain, postmodern philosophy, cosmology, and evolutionary biology. It's wide range of things. Actually, this is his second book. He wrote a first book in 2010 on global financial crisis, anatomy of fraud, demystifying the global financial crisis. And there also he tried to answer, some basic questions that what or who caused the crisis. As a layman, how do you understand that? It is not easy. Everybody talks about 2008 global financial crisis, but if you want to understand the nuances of it, as a layman, I think one must read his earlier book. It was quite fascinating, way of explaining what drove financial crisis, in 2008-9. And about this book, it's a, rethinking money and capital. And Swapnil, at one point, again, I'm going to ask you, why did you put E and N differently? Is rethinking. So you can see that it is there in the title itself. So the book is all about, I think, unorthodox thinking about on how macro works. It starts from the basic nuances of money and capital. He is arguing quite strongly, in a way we think capital or the money we use today against it. It's I think, in a sense, completely unorthodox way of thinking. There are similarities, there are differences. I find a lot of differences from where he comes from. The rethinking of their nature can be free collective engines of human race and energies of human race from several artificially imposed constraints that hold no water upon closer scrutiny. The analysis of this book leads to many counterintuitive conclusions, and this is where I find is quite fascinating, because, if somebody comes and tells you that it is money which does not cause inflation, you think really something different. Okay, here is a gentleman coming and arguing against Milton Friedman. It's a huge thing. I would really ask him to argue here, okay, in front of the audience today. And then he's kind of ending at the book with stating that fiscal policy possibly is superior, or it has more power dealing with things. Okay, I think these are something which are extremely important for us to know. Not only that, he ends with some prescriptions for emerging economies as well as developed economies. Okay, some of the prescriptions are possibly we know, but it is nuanced against a theory what he develops in his book. And a particular chapter of his book, I'll tell you, this is chapter 3, is critical, and I would request you to spend a little more time on that, where he's talking about the saving and investment balance. It's a age-old theory, but the nuances are different here. Okay, so and the book employs, I think, several other such inferences, and then he's also arguing for a few things what is happening around the world today, talking about what monetary policy should do, what monetary policy, even inflation target. He's talking about inflation target. It's I think 2 point specific target. He's arguing for a much bigger target, much wider target. Okay, all these things are in public discourse. Today we are going to hear from him. And again, Swapnil, welcome to IIMA. The floor is yours. You can take maybe 30 to 35 minutes to talk about your book, and then we start discussing on some of the key issues, and then open up for last 15 minutes for discussion. I hope that is okay.
Yeah, perfect.
Thank you.
Thanks. Thank you, Professor Das, for the kind introduction. I'll give a bit of a background as to what prompted me to, am I audible? What prompted me to write this book in the first place? It was actually an essay which I was working as a subsequent thing to my previous book, saying at the end of the financial crisis, everybody said QE is happening and fiscal stimulus is happening and so on, and there will be hyperinflation. That was the prognosis, 2009. In fact, part of the reason Bitcoin started was exactly that money will lose all value. That was the forecast back in 2009. And it sort of made sense, because conventional theory tells us that if you know the quantity theory of money, the price is proportional to quantity of money because velocity is constant. So you expect that if the quantity of money is actually 10x, your price of goods will also be 10x. But that didn't happen. So that perplexed me a bit. Why didn't actually it hold? I mean, one could say it was 5x, 4x, that's okay, but it barely moved. There was no inflation. In 2009, 10, 11, 12, we were stuck at like near zero inflation regime. The central bank balance sheets were expanding, money supply was going up. So I got curious, what is happening here? Are we taught something which is by the conventional theory, which is not in line with observation at such a magnitude, not in one isolated country in corner of the world, but in USA, in UK, in China, all major economies did massive stimulus and QE, and yet there was no inflation. So I got thinking, and I started asking simple questions like, what is money really? What happens to a deposit, a bank deposit? When does it begin its life? When does it end its life? What's the difference between the way governments handle money and the way the rest of us handle money? What happens when you pay taxes? What happens when you get subsidies? Stuff like that. And then that got me into this rabbit hole of saying, okay, central bank has a different sort of money. Banks handle each other's monies through so-called high-powered money. Rest of us work with credit money. Every time you swipe a card, for example, you're increasing the money supply for what it's worth. Every time you repay your debt, you're actually reducing money supply by whatever little amount. And we don't deal with things the way banks deal with things. So all of this then also pointed to other set of questions saying, so what is fiscal deficit and how should we think about fiscal deficit? What is inflation? How should we think about inflation? And that was like a good 8-year-long project, to put it simply. At the end of it, this book was created. So a couple of my friends gave me a lot of useful inputs and reorganized the book. And this is the final outcome. So I'll just, where's the pointers here? Okay. Cool. So the outline here is the savings glut, which even our now Nobel Prize winner Ben Bernanke talked about back then when he didn't yet win the prize, followed by the Endgame, which Professor Das talked about as the chapter 3, the endgame of our current organization and what I call the post-industrial society, post-industrial economy. Averting the endgame, and this is not a technology challenge, as much as the blockchain maximalist or Bitcoin maximalist would like to believe. It is actually an institutional challenge. It's a socio-political challenge, not a technology challenge. Then a new theory for negative risk-free interest rates. We'll see how that is justified. Myths surrounding fiscal deficits and the broad theme of what are fiscal deficits and so on. Then recommendations and lastly concluding remarks. Feel free to sort of interject. We don't have to keep the Q&A literally at the last point. If you think strongly about a point, feel free to come in. So this is a chart I created about 7-8 years ago. Once I finally put down where money comes from, where it goes in a typical closed economy. We're talking about essentially there. So there is individuals and firms, and I split the firms into two parts, producing consumer goods and producing investment goods. W is wages, I is investment, C is consumption, this is savings of individuals, profits of industry, these type of companies, profits of these type of companies. So all these flows, what I've tried to do in this specific flow is, this is stock flow consistent. There is no anomaly here, there is no ideology behind this. This is simply accounting. And so all of us sitting here in IIMA should really respect stock flow consistent theorizing, which unfortunately is missing from a lot of mainstream economic thinking. So if you make this, all your theories have to follow this, because this is not driven by any inclination. This is simply how balance sheets and P&L statements are drawn by different participants in the economy. So when wages are paid to individuals, they either consume or they save it. The firms can actually have some profits which go into their stock of savings. And then all of that collectively either goes to banks or non-bank savings mechanisms, which could be government debt or just pure money. And then firms actually raise funds from these again, these two sources, and this whole thing completes. It's important to spend some time on this, because this then helps us understand this accounting equality, that savings are equal to investments. Whereas a lot of neoclassical macroeconomic thinking suggests that savings are made equal to investments by market forces, because there is a price of money which changes the supply of money, and there is a demand for money in the investments which changes with the price, which is interest rate. And at some point they sort of match, and that's the equilibrium. That's why savings are equal to investment. That's not the case. Savings are equal to investments simply because of the accounting identity, that what is left after consumption is what goes out in this flow into savings. Now, this is not my eureka. This was known to John Maynard Keynes in 1939 itself. And so in his general theory of money, interest, and employment, he already spoke about this at length, that savings are equal to investments because the flow has to match in a closed economy. Now, what does that mean? Savings accumulate. What I mean by savings here is money savings. So throughout this presentation, I'm talking purely of monetary units. I'm not trying to confuse real economy, monetary economy. I'm just saying stock flow consistency applies in monetary sense. That's what we're talking about here. The world we live in today has this savings glut. What that means is we have falling real investments. So if you look at top 10 companies today, they're essentially sitting on a lot of cash, and they don't require actually any amount of borrowing to make any investments. 20-30 years ago, we had ExxonMobils and Fords of the world, which were constantly making investments on the back of borrowings, either through equity markets fundraise or through loans or bond markets. Now we actually have Google, Alphabet, Facebook, etc., which is sitting on cash, and any investment they need to make is essentially just acquire a company or expand their developer pool or reduce the developer pool. That means there are no avenues for sources of nominal savings to emerge. somebody has to spend more than they earn for somebody else to save. The savings paradox, if you will, or the paradox of thrift. Today, services firms dominate. The scope of expansion is dwindling, especially in the developed markets. For emerging markets, there is still scope. And there are environmental limits to endless physical growth. So we can't say 10x GDP from here could even be possible, because there's not that much soil in the world. There's not that much plastic in the world, so to speak. Services, another matter, but goods. At the other end of the spectrum, you have a steady demand in savings, nominal savings. What I mean by that is firms exist to create profit for themselves. And individuals, retirement as an institution has emerged in the last 50 to 100 years. Up to 19th century, there was no retirement logic. We all sort of just relied on the previous generation to take care of us as we grew older. But in the 20th century, especially in the developed world, retirement became a major institution, in the sense that now retirement funds dominate capital markets. So this steady demand for individual savings has nothing to do with interest rates. It is, in fact, one of the articles that I read in Economist some time back suggested that sometimes it's adverse. The savings rates fall, people are forced to save more because they're actually targeting some corpus. So it's not a straightforward relationship that if interest rates go up, people will save more, and vice versa. At best, it is chaotic. And finally, the abundance of financial capital, which is this part. Toward the next logical implication of this is that the way we treat money and capital as resources is essentially outdated since 1971. So what happened in 1971 essentially is Nixon broke the peg of US dollar with gold. With that move, fiat currencies were born in a major way. Before that, there were some experiments, but after that, everything was fiat. Now, if it's a fiat currency, and I'm not arguing against fiat currencies, in fact, I'm a big fan of fiat currencies. But fiat currencies actually tell you that what matters is not how much is money in your bank account, but what that can buy. It is a relative measure of wealth. It's not an absolute measure. So for us sitting in this room individually, we can say money matters to us because we don't print money. But for a country to say that money or capital is a constraint in our economic growth is foolish. The constraint is risk appetite, the constraint is real resources, the constraint is productivity, sure. The constraint isn't financial capital, which of course China to a great extent has shown us, and so have East Asian economies. So the previous page summarized in graphical form is this. There are 5. So our conceptualization of economy is that there are sinks of nominal savings where money settles down finally, which is either our bank accounts as profits, savings, or the firm's bank accounts as profits. And there is a demand for that, and the relatively steady one as we saw on the previous page. And there is a supply of that. The simplest supply is real investments. The companies essentially set up factories and expand. They have obviously spent borrowed money for that or accumulated savings for that. That's not spent from their revenue. So that's a new source. Fiscal deficit is another source. Money creation by central bank is another one. There is some additional sources to make its stock flow consistent from cap gains and trade surplus. This is for open economies. But 1 plus 2 plus 3 plus 4 plus 5 create this total pool available to create savings and profits, which has to match the total that finally gets split across these 3: corporate profits, individual savings, and capital export. There is no running away from this logic. And that essentially turns the conventional logic of fiscal deficit crowding out on its head. Because for an economy which is operating at full capacity, you can say that this pool is already large enough and this demand is satisfied. But if the economy is operating below full capacity, reducing fiscal deficit is actually taking away from this pool. What happens if this pool is smaller is essentially there's a, musical chairs amongst these, played in various formats. The simplest format is wage renegotiations, contract renegotiations in companies. It could be some companies going down under because they're not healthy and so on and so forth. Very many different ways, but ultimately the stock flow consistency requires that this supply has to be equal to this final demand. There might be unsatisfied demand, but the numbers have to still match. Now, with this background, we come to the endgame of free market capitalist economy, which is where we are today. Now, before I get into this, I'll just clarify what this ABM is in the first line, right? So a slight detour here on the conceptualization of the rational economic agent used in a lot of macroeconomic theorizing. Right? That rational economic agent is supposed to be representative of the economy as a whole. So 1.4 billion Indians are essentially equal to one rational economic agent into 1.4 billion. I mean, that's how the math works for the conventional theory, which means if the prices go up, demand goes down, so on and so forth for goods and services, forget capital for a while. Now, this logic is too naive because it ignores any interaction amongst the agents and their limited knowledge, because this rational economic agent is meant to be all knowledgeable, omniscient, omnipotent effectively, and having the full view of the whole world at all times. That doesn't work. So what's the alternative? So you're actually not going to write 1.4 billion equations and solve them because they're not 1.4 billion optimization problems there. So the alternative approach, which I chanced upon a very nice book called Creating Artificial Societies, I think Joshua something. Great book, MIT complexity theorist, if you will. He talks about creating this agent-based model where it's a simple computer program where you have 1.4 billion agents which have simple local knowledge and they behave consistently in their narrow context. They don't have the knowledge of, they don't have a bird's eye view. They don't have God's eye view of the economy. They simply know what happened to me yesterday, what's happening to me today, and how should I react to it. And they have rules of thumb. They don't have well-defined demand curves. So you put that together and you try to run that for like hours, depending on your compute capacity, and you come to some output of the economy as a whole. The surprising output that I kept getting, and I thought there were some bugs in my program, and so I kept running it again and again and for months together, is that this economy kept falling in terms of its output, no matter what I did, no matter how I set up the parameters. And I can share that code with you if some of you are keen to play around with it. But then I thought about the theory that was developed till then, and the output was actually not surprising. Fact of the matter is, if you look at the previous page, if these flows start to dwindle, right, this sequence is actually quite unstable. So people firms have to make profits, they will make profits, but they make profits, they obviously have to have less wages paid and more consumption done. But the individuals also want to make savings. So this system is somewhat unstable. Left to itself, it just starts to wind down in terms of output. The investments is the only thing which is keeping the whole system in check or in balance. And that investment is a function of what is the growth in the consumption in the previous years. So if you start from scratch, not what we see today in real economies, but we start from scratch from first principles, we come to this surprising conclusion that unless people irrationally decide to keep investing, most economies will keep dwindling in terms of their output. Now, that scary thought didn't materialize in 20th century because there are lots of obvious investment opportunities. And lots of people wanted to buy cars, people wanted to buy bigger houses. There was consumption demand all around in the Western world and increasingly now in the emerging market as well. That is enough to keep people investing. But as things start to, as the investment opportunities start to dwindle, which is what I call the post-industrial economy of today that we are in the Western world at least, in the bulk of the global economy, this is starting to get materialized, right? So when you combine these two things, it becomes quite a toxic combination that real consumption and investments are falling, concentration is increasing, and the only thing that is keeping private savings going is fiscal deficit as of now. That worked in US and most developed economies for last 20 odd years, where the debt kept steadily increasing. The fiscal deficit is just a counter, what do I call it? The mirror image of private savings. That kept this scenario from materializing till now, but at some point, you're starting to go towards the end game. Each of these four scenarios. What I mean by the end game is that the investment opportunities are finite. So you don't actually have adequate supply from that source. The whole world in its totality can't export to Mars. So we are obviously just playing musical chairs amongst ourselves for trade surplus. So that's out. And you're essentially then left with adequate capacity, but the concentration is making it less optimized. So these are the possible end games. One is, and the details are of course in the book, but if the government keeps printing, or not printing, but borrowing more, running deficit, making up for the gap, as we saw in this page. So if this one falls, the real investments are falling, and these are moderate, then fiscal deficit keeps filling the gap, which is there as a demand from this side for nominal savings. And that continues because they invest back in government debt. So that loop completes, is stock flow consistent and can continue near perpetually, but we're starting to hit the limits of it now from a different angle, which is there's a limit to how much government debt people are willing to tolerate. And my position is that there should be no limit. Theory doesn't dictate a limit. It's just ideology that does. And so we are now putting ideological constraint on our collective well-being. And this equilibrium, because of that, is unstable. We saw a very interesting materialization of this in 2015 or so, when some of you might have tracked the news. US government debt was downgraded for the first time in history to AA+ from AAA, because there was a concrete chance that the Congress or Senate or the combination of them would not approve the ceiling increase in absolute terms, and the US government could default on its debt. Not because they didn't have money, but because the politics was such. So that's the instability of that equilibrium. Second is quasi-feudal society, which is where you actually take the middle out just by virtue of this concentration, wealth concentration. And the rest of the economy works on sustenance. Just as back in the day, 19th century, the kings needed the population to grow so that they had more soldiers. The 21st century king equivalents require more consumers so that their profits can continue. So that's the quasi-feudal society we talk about. Third, as I mentioned, technology. Technology can postpone this for a bit. It can bring about a massive increase in productivity. And you can actually say, fine, for a few decades, this works again, because the real investment picked up. And so you had suddenly a lot of supply of savings from there. And last is then, of course, our solution. Like, how can we avoid this? Any of these endgames, which are that obviously not pleasant. So institutional innovations. Now, these are obviously somewhat bold in their scope. What I'm to reiterate the first part, which is the demand for fresh money savings is steady and rising. All of us who obviously are past certain income standard want to save. And that gets stronger and stronger as a demand with the income rising. So there's a weird non-linear relationship between savings rate and income. The person who just earns a moderate median level income may have a saving rate of 20%. You double that, the saving rate sometimes goes up to 30, instead of 40%, it doesn't remain constant, it goes up to 30%. It's 30% of a higher income. You double the income still, it might even become 70, 80% savings, because the consumption obviously doesn't keep pace with incomes beyond a certain point. So that concentration is the first part. And autonomous sources of fresh money, investments, they are falling. So the first and probably the most important central solution is countercyclical fiscal and monetary policy, which means deficits when the economy is in slack and balance and surplus budgets when the economy is running red hot, like now. So every time I speak about fiscal deficits not being important and inflation not being a monetary phenomena alone, people highlight that look around us, and what are you talking about? 10% inflation in Europe, 7% inflation in US. Clearly, the QE went too far. Clearly, the fiscal deficit, fiscal stimulus was overdone. I agree. But that doesn't negate the fact that it's the fiscal deficits run in 2020 and 2021, first half at least, that saved us from a repeat of depression. And likewise, in 2009, the massive QE and stimulus, and we'll towards the end talk about how stimulus would have been a better idea all along than QE, saved us from a depression back then as well. So if we didn't have unorthodox policy making on part of Fed and the US government and ECB and so on, We would have seen 2 depressions in last 20 years. That's at least my claim. We didn't see that. So counter-cyclical fiscal and monetary policy. Monetary side is capital adequacy. So banks actually become very aggressive during bullish periods and too conservative during bearish periods. And we saw this in 2009, 10, 11. So in 6, 7, Goldman and all other big banks in the world were very happy to lend very aggressively. They were pushing the limits of their capital adequacy ratio. But come 2010, they were all sitting on government debt. So there is so much of QE, and yet they didn't lend. So it wasn't lack of money or lack of capital. They just didn't have the risk appetite. The countercyclical fiscal monetary policy would be to say capital adequacy during bull run should be high. So you have a tendency to lend less and less and less and less. And during bearish times, it needs to come down so that you can actually lend more aggressively for whosoever is willing to borrow. Lastly, the 3 aspects of UBI, fiscal deficit on public goods and risk taking from things like equities bank. So in UBI, for example, it's often thought of as a dole. UBI is thought of as universal basic income is like feel good policy, just give people something so that it's a little bit more equal society. It's not that, as per at least this theory. The agent-based models that I ran were actually stabler if there was an airdrop, as we call it in Web3 domain, but let's say it was UBI every year of a certain amount. What that did was it brought enough money supply in the economy to create nominal demand for real goods, which did 2 things. One, it kept the consumption moderate and growing. Secondly, it created enough avenues for savings. So the previous pool that we talked about, the central bank money printing was this logic. So if you actually give people money, they will go and spend it. That will lead to saving demand being satisfied for the bank, the big firms and major savers. So that loop then completed much more nicely than government having to do fiscal deficit. Secondly, the entrepreneurs now had a very strong reason to believe that there is income. Even if there is a bit of a recession, the UBI will give people enough money to buy our goods. And in my previous talk on this book, I was talking at some investment manager in India, and they brought out a very concrete point that when Endrega stopped, or not stopped, but when Endrega numbers went down, the FMCG companies' profits went down. And the direct linkage, right? Because the Endrega beneficiaries are all these mid to low income people in rural areas who spent on sabun tail and stuff. Now, they didn't have enough money to buy sabun tail, and so obviously they kept buying some, but maybe little less, and whatever they did, somehow the money didn't make its way to FMCG companies. And then so on and so forth, right? So Endrega is as close to UBI as we could get in India. And that has obviously played out as an interesting experiment across regimes. Likewise in the US, and now of course it's overdone, but during 2020 COVID, firms still could survive because consumers kept getting money, free money from the government, which they could spend. And that wasn't a dole necessarily only for them, it was a dole also for the companies, because they spent and the money went to the companies in the process. So UBI is not a dole. All the more so if the economy is running below full capacity. So you marry that logic to the counter-cyclical policy and say, fine, if the economy is running red hot, you reduce UBI. If it's running at low capacity, then obviously increase it. Deficit spending on public goods like blue sky innovation, climate-oriented policies. We'll talk more later on this, but that's the endgame version. I'll pause here if there are any obvious questions before we go to this.
Now that is very counterintuitive to a person like me who thinks that as soon as fiscal deficit increases, a person like me will have his savings to go down. So how do you come to the conclusion that it is linear in relationship?
So actually this is the famous paradox of thrift. If some of you have heard of it. It's basically, it came up even before governments are around or fiscal deficits are around. It essentially says that if everybody in an economy, and think of it as a closed town which doesn't do business with other towns around it. Let's say there are 1,000 people in it, and they just deal with each other. Now, everybody's income is somebody's expense, or everybody's expense is somebody's income. Now, the moment somebody decides to save, somebody's income is going to go down. and their consumption will go down. So what they actually in turn buy from the rest of the participants in that town will go down as well. It cascades to some extent, but the counterpoint of that is that if somebody spends more than they should, it's also somebody else's income. So the savings of somebody else will go up. So one person's deficit is another person's saving, especially in a closed economy. Fiscal deficit is equal to, so to put it this way, mathematically speaking, the sum total of surpluses plus deficits is 0 across all participants. There are 3 participants, 10 participants, 1,000 participants. The crux of the matter is summation of surplus overall these participants is 0. All we're saying is that private participants, call it firms and individuals, and government, let's say 3 parties, 2 of them run surpluses. A third one has to be a deficit for the equations to match. So when the deficits are down, your savings will also have to be down. You may not realize it individually, but if you speak to everyone and add it all up, then it has to match. So that's the short, what do I call it, accounting answer. So this is, as I said, this has nothing to do with ideology. This is simply accounting tautology.
There will be a deficit on one end and there will be a surplus on the other, which is understood. But in reality, the systems are not as closed as we think it should be, right? Because this, so if you really look at a world economy as a system, there will be deficits at a country level and there'll be surpluses at a other country level, and which will reflect into exchange rates, and ability to buy goods, services, and subsequent economic cycles, right? So
For sure.
So in a closed system, it would work, but then we are really living in a world where, you know, the dollar keeps appreciating and our buying power keeps going down and kind of stuff. So how do you really marry this up? How
So
do you
I had to
solve
spend
this
like a
problem?
good year trying to figure the open economy logic, right? And the answer goes into, it'll probably take much longer, but the short answer is this logic, right? This is consistent, including this trade surplus and capital export, which this number could be negative, it will flip here, and this number could be positive and can flip here. This is a China-like economy, let's say. They have a huge trade surplus and they actually just do capital export by buying USG SEC. So from that angle, this the whole world as in its totality also follows the same logic. Summation of surpluses across all of them is 0. And the US government runs deficit obviously benefits the rest of us. And so at an individual country level, they have to add these 2 parts for sure. I agree with that. That may have implications if they have a fiscal deficit, which runs into trade deficit and then depreciates the currency, and they don't have a good enough export economy to take that benefit, then could be a lot of pain. But if you're talking about a US-like economy or a Europe-like economy, then that's relatively less dramatic, and our logic still holds. Right. So a big claim I make is the natural rate of risk-free rate, natural rate of what I call it, natural interest rate is negative in a real and risk-free sense. This is counter to the original point that a lot of macro 101 tells us, that you need some incentive to postpone consumption. And so interest rates have to be positive, so that if I consume today, I have utility from it. If I don't consume, I sort of have utility tomorrow. So tomorrow utility has to be more than today's, so interest rate has to be positive. But to quickly cover this, there is a macro context and micro context in which the fact that my money is actually an open-ended option on goods and services. Of course, I'll leave the details for you to read in the book, but the fact that I can choose to consume today or later, I can use it to save for my retirement years and so on and so forth. It's a very powerful embedded option in money, which is not there in goods. So I will save even if the interest rates are 0 or negative. In the macro context, if everybody else, if the economy is running below full capacity and I save, I'm actually inflicting damage, further damage on the economy. And that it could actually have a fees in the form of negative interest rates. Long story short, you combine these 2 logics, except for the times when economy is running at full capacity, interest rates need to be negative. But real, So if there is inflation, then nominal interest rate could still be positive and only risk-free. So if you take some risk, you obviously get paid for it. So your nominal and risk-adjusted rates could still be positive and large enough. This is only to say overnight GSEC real rate should be negative. Fiscal deficit, we talked about a fair bit, so I'll skip through that. Just 4 myths. I'll quickly highlight that so that we can go to the discussion quickly. The responsibility myth. What holds for a household doesn't hold for an economy. We should all behave fiscally responsibly. That's a given. I'm not suggesting here that we should run fiscal deficits. We should save for rainy day and retirement and so on. But the economy shouldn't. There is no monetary saving at an economy level. You can only produce goods and services. Your money saving is not going to go very far. We're not burdening the future generation when we actually are running fiscal deficit. We're just producing private savings, which are mirror of the public deficit, which is their wealth. In fact, adding to their wealth for what it's worth. Crowding out. If economy is not operating at full capacity, fiscal deficit actually crowds in because it makes up for the slack in the real investment demand. And default on public debt myth. Long argument here, so I will not go into it, but no sovereign country can be forced to default on its local currency denominated debt. Eurozone is complicated, but US, China, Japan, India, local currency denominated debt, you cannot be forced to default on it. You can choose to default, which is different. But you can't be forced to default by the very nature of economics and banking. This I'll skip through. Inflation, should we take this later?
Yeah, you can take this.
I'll pause it here. We'll pause it here and then sort of go to this thing. Yeah, perfect. Because I think we'll run short of time otherwise.
Okay.
So I'll pause it here and we'll just move to the Q&A. Some of this will get covered in that, so I'll keep flipping back and forth between the slides.
Okay, thank you, Swapnil. Let me ask you something. How did you become Kenshin after studying at IIMA?
I guess I was at heart a Kenshin. I just didn't know it. So I'm also somewhat left of center. So I guess that combined tendency, then once you study this from first principles, you realize that Keynes made sense in general theory. So I'm a big fan of the book, and I think it should be read more widely.
That book is not easy to read.
It takes forever.
Yes, and the way we read macroeconomics, in that book, there is no graph.
Yeah, that's true.
So I think except for one small drawing, hand drawing things, no graph, no maths.
True.
Still all the arguments holds. That's the general theory of Keynes. Okay, so even he has become Keynes, but some part of his impression from IIMA is still there. If you see his book, in the first, while introducing his book, he is telling what part to read if you have a day's time, if you have 4 days time, what to read. So as if you have gone to a place to look around, you have some time, and he is giving a specific thing that if you have little more time, read chapter 3. Okay, so that's the crux of the book. I think there again, his impression of IIMA is very much there. So let me start with, I think maybe juxtapose what is happening today vis-a-vis what we have seen in 1970s. Okay, so in 1970s we had sudden surge of inflation around the world. Most of the countries around the world started facing low growth. We understood or nuances of stagflation, and against this background, actually we moved away from Keynesian to capitalist economist view. And what we have got today is again huge inflation, surge of low growth, actually breathing on our shoulder. But you are proposing not that time the solution was going away from Keynesian. Now you are proposing, I think, going into Keynesian. What are your views on that?
So I think most of my analysis can be summed up with the 2 words, counter-cyclical. And obviously hindsight is 2020. So I can say that the fiscal stimulus was overdone in 2021, but that is the prognosis. Now, 70s also same logic. Before, I remember reading somewhere that by the end of 60s, people were making statements like, we're all Keynesians now. like politicians are making statements like that. That starts to look very dangerous. This is in a dangerous territory. And 71, around Vietnam War, Nixon kept doing spending on deficits, although there was nominal growth in GDP was very high.
Yeah.
And despite early signs of inflation, they didn't stop because it seemed like a self-solving thing. Same thing now. I think we are sitting in a time where the fiscal stimulus has prompted people to drop out of workforce, which is why the unemployment rate seems to be at an all-time low, and it's just not budging, despite all the activities around tightening, belt tightening, and so on. We still have lots of vacancies, especially in the US. And you combine that with the nasty shock similar to 70s of the Ukraine war, oil price and gas price and all going up, were the same cocktail. But I think the solution here too, back then we paid for the solution through massive unemployment for quite some time, a recession which is very long drawn. I think the solution doesn't need to be that drastic this time. If you realize a simple thing that part of this inflation is not going to go away no matter what we do. The interest rates can be 20%, and yet gas price is not going to respond to it, because the crude oil price or gas price is not a function of interest rates, no matter what we say. Rest of the economy may cool down, but essentially it's a measure like to cure the fever, we're giving the patient something like a even bigger disease. So I guess the short answer is that targeted policies, which could still be called Kenshin, which reduce the pain and still reduce the nominal GDP. I think that's what I propose as alternative to inflation, targeting stability in nominal GDP. If you look at 2020 to 21 to 22, the nominal GDP suddenly shot up. And that is already a good reason to start going counter-cyclical and reducing the UBI equivalent, which is the government handouts. Should have stopped long back, and fiscal deficit and public works.
Is it one reason for you to base your recommendation for monetary policy targeting not just inflation, but nominal growth?
Absolutely. So I think inflation, in fact, that comes in nicely here. This complicated looking graph has a simple point, which is that look at these thick red pipes. These are what I call goods pipes, goods and services pipes. And the dotted line pipes are all capital pipes. The thing is, the fluid going through all of this, which is money, is the same. It's not there are two types of monies, one money for assets and one money for payments of goods and services. So there are very many, so if you summarize that into these equations, the flow equation of lending by banks and asset creation by central bank matches this. And this last term, delta money goods, the middle term, is what causes inflation. Now, any combination, even if you make this left-hand side 0, any combination of these three can work to keep the middle part non-zero and big. So your inflation can be, this is the part about anti-Friedman. Like, it's not a monetary phenomena. Money does affect it. Money is the left-hand side of the equation. So everything remains proportionate, then obviously, yes, this will proportionately increase it. But things are so complex that it is not proportionate. So you could actually see, for example, what happened through 2010s was a rapid increase in asset prices, but goods and services didn't become costly, although the left-hand side was going up sharply. And now we may actually try to constrain left-hand side very drastically through monetary policy, but the money spent on goods is going to keep going up because the goods are inherently costly on account of supply shocks. So I guess that's the distinction I was trying to make.
And the other point I wanted to, ask you your view on that, while we moved away from Kenshin to new Kenshin in early 1980s, the basic idea came from Hayek. Okay, and he argued primarily that if we depend too much on government, it's a threat to independence, threat to the freedom of thinking itself. And that led to severe, I think, distortion in many things, license Raj to everything, How do you think that we are not risking the economy if we believe your recommendations are worth taking in?
So I like UBI for that reason, actually, because the good thing about UBI as against, so let's say two parts to the answer. First part is what I call fiscal policy board as distinct from expenditure policy. So in a budget, for example, we call budget and what you Americans call something else. there is a conflation of two issues. How big a fiscal deficit we should have and where should we spend it? Whereas I think there are two policy choices here. One is to say, just as central bank sets interest rates, there should be an independent fiscal policy board which sets fiscal deficit target for each year. And it just tells the government that this is the fiscal deficit we need to run. How do you get to that point is your call. Raise taxes, raise expense, reduce expense. That's the fiscal deficit. We need to meet it no matter what for the stability of the macroeconomic evolution. Then expenditure, what you spend on is the expenditure policy, which is political choice, right? What is your preference and priority and so on. Now, as a part of the second answer, now if I say instead of the government saying that let's spend on bridges versus let's spend on education versus whatever else, defense, which could also divide a lot of people into camps. UBI is clean because you're saying that you just print the money, give it to the individuals. They will figure out what is good for them. And it's egalitarian because everybody gets the same amount. So you're not even actually preferring one party versus another. And I'm not even saying leave the rich out. Give it to everyone. Give it to Mr. Mukesh Ambani also, for all I care. It won't make a difference in his life, and he might not even take it. But for the rest of us, especially the bottom half, it will go a long way in then letting the markets decide. So you're still creating a fiscal deficit, but you're not distorting the economy by saying, I'll build bridges versus I'll do social spending. You're saying people will decide. They want to spend on mobile phones and data, they'll spend on that. They want to spend on oil, they'll spend on oil. They want to spend on weddings, they'll spend on weddings. But that then still matches the two concerns, that Hayekian concern that you'll give away too much responsibility. So if you institutionalize this, might still work.
Okay, thank you. And then maybe I'll ask you a couple of questions and then, or maybe your view, and then I'll open up for the point about saving and investment, and then when you talked about paradox of thrift, one key component in that analysis is inventory. So I do not see that not much of discussion about inventory because it works through that. The cycle works through managing inventory, and that's why inventory is key component of investment, which is very fundamental of C plus I plus G plus NX.
Yeah.
So why did you not talk much about, I know when you explained that, you did talk about it in a cycle, it works.
Right.
Yeah, but I do not see much about discussion on inventory in your book.
The short answer is it's a work to do for me. It's probably additional analysis that I need to do. Would love for others' views on that as well. A somewhat shortcut of an answer is that I clubbed them together, saying that all assets of a company, whether they are fixed assets or current assets, there's still places where money is stuck in some sense. Obviously, the latter is more liquid, but it's still money locked in that. So that still counts as investment. And so if, for example, if a firm were to expand rapidly, only in its working capital, that is still in the books of this analysis, still a real investment because they are actually spending more than they have in cash flow terms. So that, I guess, is a bit of a cop-out answer. And the short answer is, yeah, I need to work on this.
Okay, and then the last point I want your view, when you talked about 2007-8 QE not resulting in inflation in standard macro, a lot has been written on it, is that inflation expectation did not move. Okay, so it's not that QE of 2007-8-9, which was the first thing attempted. QE was very much attempted by Japan much earlier. Okay, and Japan tried almost 2 decades to inflation back, to get inflation back. It did not, with so much of QE. And most of the macroeconomic explanation of QE not resulting in inflation is that expectation did not move. And that has something to do with your trade surplus of many other countries. Okay. And very different things started happening now. Suddenly you find there is supply disruption and the economy like Japan started showing up inflation. So how, in your book, again, I do not find much, talk about expectation channel relative to other points.
So on expectations, I'm somewhat divided, frankly. I do think that people follow thumb rules. But if you look at expectations, and I had done this during my hedge fund days, I was trying to figure out if I can use expectations in some way to predict the profitability of FMCG companies. or their reduced profits. Turns out that expectations are very backward looking. So when you do a survey of households and ask them about the inflation expectations, many of them just look back at last 12 months or 3-4 months. That probably is the most rational response also. So I haven't done adequate research to claim this, that expectations are not a good anchor for the future inflation point per se, nor are they self-fulfilling, frankly, beyond a point. But work to be done on that front also. What surprised me, especially in the QE side, was that the order of magnitude. So if you do 5x money supply and you expect prices to jump 5x, which means 400% inflation, and you realize 0, then that's dramatically off. If you got like a 80, 90, 100, 200% inflation, then you say, fine, the theory could explain some difference. But you got literally near deflationary scenario and a 5x increase in 5x or more higher increase in money supply, and that can't be explained away by just expectations alone. At least that's my thought.
Okay, thank you, Swapnil. So now, Swapnil, you can take maybe a couple of minutes to give your recommendation for emerging and developed economies, and then we'll open up for.
Cool. So thanks. The India side is straightforward. I created this objective function saying jointly maximize minimum consumption and rate of accumulation of physical and human capital. For developed economies, it's just simpler, which is third one. Maximize minimum consumption of everyone in the population over an extended period of time. So that's an ideological choice. This part is clearly ideological. This is not first principles. Solutions in Indian context, create DFI banks, not DFIs. So we obviously had a very bad run with DFIs in the 90s. So DFI banks, which can borrow from interbank market and from the capital markets. Fiscal incentives for real investments. And this worked, for example, in pockets like solar and so on, where we got accelerated depreciation. Expand that to pretty much everything under the sun. Real investments are very valuable to maintain macro stability. They reduce the demand from fiscal deficit, so it's useful to promote real investments. Not through tax cuts, which are generic, which the current government tried, because they don't really affect investment behavior, but giving very specific investment-related benefits. Human capital, which is on education stamps, health stamps. What I mean by stamps is money that can be spent only on that. So you give stamps, which then like food stamps have been tried in the US. To do that in the education and health context also, don't run the education sector yourself, let the private sector run it, but just give a lot of stamps, which people can use to pay, and the government then sort of redeems them. Net exports, which is to the point earlier, I think you made of economy running fiscal deficits and getting then on the wrong side of the rest of the world by being forced to have a bad trade surplus and poor exchange rate. That is to be solved through net exports, which of course, Make in India seems like a good slogan. If that does materialize into some real trade surplus increase, that will be nice as well. And then attitudinal reforms, which are just these 4 things. Obsession with fiscal deficit, we need to drop that as a developing economy for sure. Widen inflation tolerance band, use banking system aggressively. And lastly, this financial repression is just a term coined by neoclassical economists to crow about low interest rates. That's all. And there is no real phenomena here called financial repression. So yeah, it should be actually. I think I missed that. But yeah, UBIF, sure. Yeah, that's
Okay, thank you. Now questions. Yes.
Yeah, myself Mukesh, and congratulations for your new book and my best wishes. Let's come out from the theory to practical. My questions are, if you feel that it's out of the way, but still I have 2 questions. One is dollar is becoming stronger day by day, even though we are strong with other economies. Reasons I would like to know in short. And second one is, in your opinion as a financial expert, can we reach 5 trillion economy before 24th new election?
okay.
No, general opinion I want.
Second one is easier to answer. I'm going to say that.
No, as a financial expert, you must be knowing that whether, because we are doing based in our GDP, we are doing based our GST collection every month, our collection is going up and up. Can we reach the target? Thank you.
Sure. So I'll answer the second one first. Again, my personal analysis has not been detailed enough to give a definitive answer to that. I'm not hopeful, but I can't specify why exactly I'm saying that. But yeah, short answer is not hopeful of the 5 trillion number by 2024 for sure. Sooner, maybe soon after that. The first part, dollar strength is dollar strength is a function of essentially risk aversion in the global economy. And that is more to do with capital flows than with trade flows. What I mean by that is when the world is generally bullish, Americans export capital. And so they're essentially chasing the whole world looking for yield. When the yield in their home country are already rising and the risk aversion in general is high, the preference, this is basically it boils down to asset allocations of very major investors. The asset allocations are shifting towards debt, and within debt, they're shifting towards developed market debt, and all the more so US debt, which means money is heading back into dollars from rupee, yen, Swiss franc, and so on. And of course, rupiah and all other emerging currencies also. So it's a reflection of capital account than current account.
I have very two small questions.
Sure.
So the first one is, why is the cost of money so high in India, especially compared to the top 5 GDPs in the world, especially compared to the US?
Sure.
And second is, it's about the first principles that you talk, that as an emerging economy, we should not care much about fiscal deficit, which I agree that government has no business making profit as long as it facilitates private saving and consumption. But I have a doubt that isn't fiscal deficit limited, and I can be wrong, I want you to clarify that. Isn't it limited by our currency being backed by gold, that we cannot go beyond a certain limit, even if we want to? Is that a case or not?
Also, fiscal deficit is the second question. And first one you were saying was, the cost of, also that one we're on the same page. I think the cost of money is too high in India. It should be way lower. And if you want to take a cue from the economies which did reasonably well in the last 2 decades, right? East Asia and China. They all kept cost of money low, and people, the Western economists talked about that being financial repression with like reams of paper, but the economies grew still. And obviously people said we were making less than more money than we could have, but their income was rising. So what do you want to give people? A higher return on their investment or better income? And this is not a short answer because this is a political choice. So what John Maynard Keynes also talked about in his book was the rentiers, who essentially are crowing about the repression, versus hardworking, I mean, this is an ideological point again, but entrepreneurs and hardworking individuals, like all of us here, hopefully, are basically earning each year income and saving from that. So for us, what matters is income. And so if the economy is growing sharply, then incomes will rise. We don't care if the interest rates are low because our incomes are growing well, fine. That's the Chinese phenomena. And I agree with you that Indian interest rates should be way lower. Real interest rates should definitely be negative for extended periods of time. We are nowhere near full capacity. And there is no reason for us to actually have such high interest rates. Second answer, on the fiscal deficit side, Indian currency, like all other major currencies, fiat backed. There is no gold, just so that we're all on the same page. Sitting in central bank has gold as assets, but that is not backing our currency notes. So, and nor is it in US or any other country for that matter. So since 1971, the whole world is in fiat mode. And hence, here onwards, what matters is how do you balance things like trade surplus. Running a huge fiscal deficit and a trade deficit is dangerous. That goes without saying. But if you can get your trade deficit under control or reduce it maybe even to trade surplus or at least neutral, then you have a lot of latitude on fiscal deficit. A lot depends on what type of economy you are. US does both. They do huge fiscal deficit and huge trade deficit. But then you have to be US for that.
So I was just thinking, if you thought about inequality in this context, for instance, common concern that comes up when you talk about Manrega wages is that it is pricing out the small landholders who would like to hire, and so wages are too high because of this. Now, if you start giving out UBI, it could be that small firms are priced out because they can't afford wages. Wages have gone up because people don't want to work. And so what remains are just a few big firms. Is that part of your
It's
model?
actually a very valid concern, and I will have to run a few more models to actually sensibly answer that. I can venture at a answer which essentially runs as follows: that you don't want to bring about UBI in a rush where it disrupts the economy so much that the firms don't have time to adjust their pricing. So in our utopian version of UBI implementation, you would actually have small firms take enough time to adjust their pricing suitably upwards to reflect or pass on what they are facing because of the wage rise at the UBI side or triggered by UBI. Because ultimately, many of these small firms are serving those same individuals, right? So to that extent, you are actually hoping that this additional supply of money is making these people also able to pay higher for the services of these small firms. Or to take a more roundabout way, you said these people are earning more. They buy more sabun tel, those guys spend more on capex, and then those guys spend more on wages, and then so flows back the amount all the way to small firms in paying them higher prices, which they are demanding now because of the higher wages. But yeah, it'll have to be a gradual process. Otherwise, what you said could happen. Inequality in firms can rise at the expense of inequality in individuals falling. Potential.
What they spend on.
Right.
If the demand increases for the larger firms, you get one kind of a result. The demand increase is equitably distributed, you get another kind of result. If you find that the concentration is with the small firms, that you get a, so if the concentration with a small firm, their ability to pay higher would increase.
True.
But so the composition of demand, I suppose, the change in the composition of demand as UBI kicks in, would bring in this unique, I mean, I don't know. I mean, I'm just guessing.
I see that. Actually, in fact, one could then extend that argument and say the UBI as money versus UBI as stamps, right? That could make a bit of a difference as well. With directed money, it's like the CBDC comes into picture. You can actually you can restrict the money's end consumption. So you can say this cannot be spent on this, which then can steer money more in the local economy. And then hence keep UBI a little bit more egalitarian also. Potential. Lots of work.
Yes, I'm curious about the earlier statement that QE was done 5 times.
When QE was done 5 times or 10 times and the inflation didn't happen at all, and it was partly due to expectations, which was what Abhiman was saying, the literature is suggesting, and you argued that expectations may explain a little bit of it, but there's a lot that is unexplained. So just like you to speculate on the unexplained part, what would be the other factors there?
You mean in
that explains why there was no inflation in the earlier round of QE.
Okay. Oh, that part I'm relatively sure about, which is why there was no inflation is because of the this part which I talked about earlier. So to take a quick look at the conventional theory, the logic was that this split of what amount is floating about in these pipes, goods and services pipes, and what amount is floating about in the capital asset pipes, if you will, is constant. The proportion is constant. If you make that assumption, which is a very dangerous assumption, it doesn't hold in real life. But if you make that assumption, then I forgot the exact terms, but there is some PY, Q something is equal to PY, the quantity theory of money. And linked logic there was if the quantity of money is simply equal to high powered money into the money multiplier, which is something to do with the fractional reserve banking. So the whole thing was a simple thing saying high powered money goes up with the money multiplier and the fractional reserve banking, overall money supply goes up. And because of the quantity theory of money, prices go up. So QE was this part going up. The high powered money went up 10x. It got broken in the immediate next step, that the credit money in the economy, so to speak, didn't go up by the same proportion. So, which is what I referred to earlier as the fact that the big banks during this period became actually very risk averse. So they, using the capital adequacy ratio that was available to them and the fractional banking reserve ratio available to them, would have lent a lot more, but they just didn't. So all of them were just parking money with the central bank or buying government bonds in the repo market and so on. So to answer your question, the 4x extra money kept floating about here. And that too largely between the government, the central bank in the US context, Fed, and the interbank market and the repo market. That's where everything stayed. So we didn't see any inflation on this side of the things, which also is the other point about how fiscal policy is superior to monetary policy, because in monetary policy, all that can vary is just the amount of money. Fiscal, you can actually start to affect these components individually.
Okay, any more questions?
I'm sorry for asking again.
No worries, you're asking on others' behalf. I guess.
Okay, so my question is, you say that UBI can be given out in terms of money stamps. So let's take example of school and healthcare. So how is it different from giving away free schooling and free healthcare instead of a UBI money stamp?
Oh, there's a whole lot of research on this, and I'm glad you asked the question. When you're actually giving away free schooling, what you're saying is, as a government, I know who are the best teachers, I know what's the best way to organize schools, and I'm just going to tell all you beneficiaries that go to this school because I, the government, am telling you this is the best school. Whereas if you give the education stamps, you're just telling private entrepreneurs, go set up schools, try to recruit students in your schools, the best school will win. And whosoever brings me the most stamps, I'll give them the most money. So that's transparent. And you're not, as a government, spending any energy whatsoever on saying, how do I recruit teachers, and should I set up a building here, or how many villages should make up for one school? All of that is left to private choices.
Okay, I think we are already running out of time, but I'll just end with I think your comment on that. In the book, you said about the political economy of monetary policy and fiscal.
Right.
Okay, but at the same time, you want a fiscal board which is independent.
That's
how would they work then?
I'll take a step back here and qualify the term fiscal independence or independent board. I do think that the noise around central bank independence is overdone. I do think the central bank should answer to the government, and as bad or good the consequences may be, because central bank is not elected, the government is elected. So we may choose to say things against the government, sure, but the central bank, as in a technocratic manner, deciding that this is good for the economy and this is not good for the economy, is somewhat non-democratic in my view. So then dovetailing into that, the answer to your question, the fiscal policy board and the monetary policy body, which is central bank, both answer to the government, but their mandate is very clear, so it's transparently discussable in public forums. With central bank is saying nominal GDP growth stability, and so the argument is around, will this help that, will this not help that? So there is no behind closed door conversations around, let's do this anyway. Likewise for fiscal policy board, they are only trying to see how do we actually make up for slack in the economy, or in fact the economy is red hot, let's make fiscal surplus. Their analysis is open to public scrutiny and their discussion is open to public scrutiny, but their mandate is not. So that's what I meant, that the mandates are very transparently given, and then you sort of take that output and the government just runs with it.
Okay, thank you, Swapnil,
My
for
pleasure.
such illuminating, I think, discussion and on your book. All the best for your book, and whoever is there in this room, please buy his book and read it. Okay, so thank you on behalf
My
of
pleasure.
IIMA.
Thank you.
Thank you for coming over and presenting the book.
Thanks. Oh, thank you.
Appreciation from delivering this understanding. Thank you to Professor Abhiman Das for having moderated.
Thank you, sir.
Thank you all.
Hi.